What is portfolio insurance, and how did it affect Black Monday? Imagine a safety net that adjusts itself as the market moves, trying to protect your investments from big drops. That's what portfolio insurance was meant to do. It was a strategy used mainly in the 1980s to limit losses without selling stocks directly. Instead, investors would buy and sell stock index futures, which are contracts that agree to buy or sell stocks at a set price in the future. When the market started to fall, the strategy would automatically sell futures to reduce exposure, acting like a protective barrier. When the market rose, it would buy more futures to participate in gains. The goal was to keep losses small while still benefiting from upward moves. One popular form of this strategy was called constant proportion portfolio insurance. It worked by calculating a cushion, which is the difference between the current portfolio value and a set minimum value, called the floor. A multiplier was applied to this cushion to decide how much money to invest in risky stocks. If the market dropped and the cushion shrank, the system would automatically shift more money into safer assets like bonds or cash. If the market rose, it would invest more in stocks to catch the gains. During Black Monday on October 19, 1987, this strategy played a surprising role. As stock prices started to fall sharply, many investors using portfolio insurance began selling large amounts of futures contracts to protect their portfolios. This mass selling created a huge wave of pressure on the market. Because the strategy was mechanical and based on formulas, it caused a feedback loop. Falling prices triggered more selling, which pushed prices down even further. This rapid chain reaction made the market plummet in a matter of hours, with the Dow Jones Industrial Average dropping by over 25% in a single day. The event revealed a big flaw in portfolio insurance. It assumed markets could handle the volume of selling generated by the strategy. But during Black Monday, the sheer amount of futures being sold overwhelmed market liquidity. Prices collapsed quickly because there weren't enough buyers to absorb the selling. This caused a panic and increased volatility across global markets. Looking back, Black Monday showed how a risk management tool designed to limit losses could unintentionally make a crash worse. It led regulators to rethink rules about trading and how to prevent similar feedback loops from happening again. Today, the lessons from that day reminded us that even well-intentioned strategies can have unexpected effects when many investors act the same way at once.